Hello and welcome back to the Future Value Podcast. I'm John Pellosie alongside Joe Freemont and Justin Ahner. Today we're going to be talking all about cash, cold hard cash, right? And we say that cash is king. We want to share how cash fits into people's financial plan, why it's such an important building block of any asset management program and growing your net worth. And we're going to talk about the different types of cash accounts that are out there. There's a number of different vehicles for cash. And then we're going to talk some more about how to use it and some strategy around it. So I want to start with you, Justin and Joe. If you want to, feel free to share with people just some of the different cash saving vehicles that are out there. I think most people are familiar with some of the terms, but maybe they don't quite understand all the different distinctions that are out there.
Sure, yeah, I can take that one. Having come from banking, I got very familiar with the different types of cash accounts. That was one of my primary roles before I got to Legacy was opening those accounts for clients. So the very basic account that you can have is your first checking account. Mm-hmm. That's a cash account where you can typically pay bills out of, write checks, attach a debit card. That's your typical spending account. Typically, you want to leave your balances a little bit lower in there. You don't want to carry, huge balances because the risk for fraud is there. Mm-hmm. There's a big potential for, say you lose your card or someone steals a check. It's a lot harder to protect that money than it is in some other accounts that you could have. Another type of account that most folks have is your traditional savings account. That's your basic saver. I'm going to put some money away for later for that the rainy day fund, or as I'm sure we'll discuss in a couple minutes, the emergency fund. The third type of account that I dealt a lot with, and I know that we talk frequently about, is a money market account. That's similar to a savings account. It's a savings vehicle, and typically you're looking to earn a little bit more interest in there as compared to your checking account, which earns typically next to nothing, and the savings account, which is typically much lower than a money market account.
So, Justin, going back to the checking account, you had said, you want to be able to cover your bills, but you don't necessarily want to have too much in there because of that risk of fraud or people gaining access if you lose your card. So, what are some things that people can do to protect against having too much in there, but also making sure they're not overdrafting or doing things like that? Is there any solutions for that?
Yeah, definitely. One of the solutions that we did a lot at the bank was actually setting up overdraft protection. So you can link a savings account directly to your checking account. That way, if you were to say, I'm overspending by a couple bucks, the bank will allow an overdraft to be pulled from the savings account.
Okay.
There are also some other protections that the bank will offer that, if it's over a certain amount, they will do their best to not pay. But typically that's something that you need to have set up when you're setting the account up.
Got it. All right.
So is there limits to that overdraft, Justin? Because, part of the safety of, not keeping too much in your checking account is keeping that balance low. If you have that linked savings account, is there a limit to that overdraft protection? Like, let's say somebody gets access to your check or debit card or whatever and racks up a super large payment. Does that overdraft hit a certain limit and then stops? Or is that a separate type of savings account that you keep a different balance in, separate from emergency funds and such?
Yeah, not that I think that there was any limits. Certainly, I'm sure it's bank by bank. Certainly, I'm sure banks have different policy on what they'll allow. I know for us, I don't think it was I don't think it was limited. Meaning that you're right. If you have it set up for overdraft, the potential to lose more money is certainly there.
Great. I think another great point you brought up about checking accounts, Justin, was they're primarily bill-paying accounts, right? So they're not earning any interest for you, right? So another reason why you might not want to keep a ton of money in your checking account is that it's not working for you, right? You're working so hard to get those dollar bills into your account from your job that why shouldn't your money work just as hard as you work for it, right?
Exactly.
So I think that's another reason, other than just security purposes, to keep not as much in your checking account.
Mm-hmm. Joe, have you ever seen any situations when you're working with clients of people maybe not having that right balance between checking and savings?
Absolutely. Yeah, I had a client the other day that we were reviewing their accounts and making sure they were a relatively new client. And what I discovered was that they kept over $100,000 in their checking account. $100,000. So what that means is they were missing out on valuable interest, right? And even before COVID, when we had relatively low interest rates, I mean, they still would have gotten at least $1,000 a year if they had 1% interest on that account for an annual rate. And today, if they had kept that in cash, I mean, they're missing out on much more than that.
Yeah.
So it is quite an extreme example of, hey, you want to make sure that your money is working for you.
And I think I've heard, in recent years, this kind of concept of like the online savings accounts becoming much more prevalent. I've seen that with clients too. Like maybe one of you could talk about that concept. Like what is this online type of savings account?
Yeah, absolutely. So I think John is right on the nose there. There's been a kind of a online bank relevancy recently where these high yield savings accounts are popping up more than ever. I think one of the more viral ones that I've seen online is the Apple opened up a high yield savings account, right? So everyone's raving about Apple. They know Apple from their products. Maybe it's their phone or their watch or their laptop, and they say, okay, Apple's offering an online savings account that's offering mid 4s to high to low 5s% at that one point in time. So these online banks that don't have brick and mortar stores are able to offer a higher rate of interest because they're not paying for the real estate. They're not paying for the cost of having employees on deck, right? Or not that they don't have employees, but rather they don't have to staff them at multiple locations all over the United States.
Got it. So, if is online banking something that you use yourself, Joe?
Yeah, absolutely. I keep a lot of I have a primary brick and mortar bank that I do most of my checking at. But I keep a majority of my savings in an online savings account because of the higher yield.
And as clients are evaluating that decision, is there any guidance when you're, to make a selection from one versus the other? Like, what are some important factors you'd say they'd want to look at?
Absolutely. I get this question a lot, actually. So first and foremost, always read the fine print. All right. So I actually had a good friend of mine who was looking at multiple high yield savings accounts. He came to me and he said, Joe, well, I thought I was getting this high rate at my bank, but it turns out I didn't read the fine print. I needed to set up a automatic deposit for my job. So they didn't want just you to put a lump sum of money in and earn that high rate. They wanted you to be consistently putting more money in, right? So I think it's really important to read the terms and conditions, right? Check for hidden fees, right? There might be transaction fees if you're contributing from another account, or maybe just a fee to have a balance at that bank. So keep an eye out for that small text.
And I think in all of these things, the table stakes, of course, is FDIC insurance, right? So making sure that whatever account, whether it's a brick and mortar or an online type of savings account, that it has that FDIC protection, so that if the bank were to go under and go out of business, that money is backed up through the federal protection.
And what limit is that, John?
Yep. So for individual depositors, that's $250,000. That coverage can be extended based on some things around joint ownership or things of that nature. Certainly, one of the things that I've counseled clients on is if they're in a situation where they're going to be over the FDIC threshold at one particular bank, they really ought to look at splitting up where they're holding their cash to make sure that they're getting that maximum protection. So it may be that they're using two different banks, for their cash, but making sure that there's those protections extended.
Absolutely. And I think something that my clients get, particularly on the younger side, get a little confused on is that $250,000 by account, right? Is that checking, by savings, or is that by institution?
So that's by institution. So you as a depositor are guaranteed for that $250,000 between any accounts that you have there. So that could be spread between checking, savings, CDs, those types of things. But it's not, I'm guaranteed 250 in checking, 250 in savings, 250, so on and so forth.
As we kind of continue our discussion around cash, what are some of the important uses or the strategy, right? Like obviously we have checking to pay our bills, right? So it's to keep the lights on, keep us in our homes, and make sure our lives keep running. But I guess over and beyond that, like, what are some more of the strategic things people need to be thinking about when it comes to, how much cash in total they should have and things like that?
Well, we have a golden rule here at Legacy, and I think probably broader in the financial services industry, that you should keep 3 to 6 months of your expenses in an emergency fund. So what do we all mean when we say emergency fund? Well, that means, first off, that you're not looking at it every day. I would highly suggest that you keep these emergency funds, so that's 3 to 6 months of maybe your rent, your typical utilities, budget some fun in there. Fun money is always important, right? That you're keeping in an account that you're not necessarily looking at every day, right? So not at a place where you're doing all your checking, preferably, so that it's out of sight and out of mind.
I would say one important consideration for that as well is, given that range, 3 to 6 months, someone might be saying, well, what's right for me? You got to consider factors such as, like your employment. Someone who's collecting a salary weekly or an hourly paycheck that's pretty regular, you would probably be a little bit safer on the lower end. But someone who is a little bit more commission-based or a little more sporadic in the pay, you should probably be looking towards that 6 or potentially even more, depending on your pay structure.
Yeah, and I would agree with that, and add also, when we look at in particular families or couples, how is their kind of income structured, right? Is it a single income family? Is it a dual income family? I think those factors can play into, obviously, if it's a single income, we may want to tend more to that little bit more conservative 6-month kind of span for their cash.
Yeah, and I would just clarify, to go off of all that, that's all great information, that there's no such account such as an emergency fund, right? We're talking about the savings accounts, maybe some certificates of deposit, CDs, which I don't think we covered yet so far, but maybe that's that high yield savings account, anywhere where you're really getting the highest rate of interest within the reasons and the parameters that we've talked about before.
So that 3 to 6 months, that's really for, I guess, planning against unexpected expenses or like a disruption in income, like unemployment, things like that?
Absolutely. It's not vacation money. It's not renovation money. It's, oh crap, I need 4 tires.
Yes.
And I wasn't planning on that this year, right?
Well, I definitely can share, and I'm sure the two of you have stories like this too, where as being a homeowner now, there's definitely been times where there's been a 5-figure kind of surprise bill. So having those emergency funds is very, very important. I can say that from experience.
Right, and the key piece about that is that you don't have to go out and borrow for it, because that makes it a lot more costly. Certainly if an expense like that comes up, you could certainly put it on the credit card or go and get a personal loan for it. But ultimately, that $10,000 fix or whatever the emergency may be could end up costing you, $15,000 or even double if you're using credit instead of being prepared with the emergency fund.
Yeah, that's a good point. So over and beyond this emergency fund, this 3 to 6 months, in cash, is there any other amounts maybe people would want to consider in their cash?
Yeah, I think that's a great point. Well, like I said before, we don't want to keep, or ideally in my situation, I want to keep my emergency fund separate, right? So that's at a different institution that I'm not looking at necessarily every day. But what I like to have in my checking is, of course, always the amount that'll get me through the month, right? So we're not keeping that balance too high, but those recurrable expenses that I know are going to happen month to month are definitely in my checking in any given month. But what I like to have set up, and this, I'm curious to see how you guys think about this, is I also have separate savings accounts at that same institution.
Earlier we were talking a little bit about online savings accounts versus kind of your traditional brick and mortar bank with checking and savings and all of that. So, we said the online can offer you a little bit more attractive interest rates on savings. With that in mind, why might you still want to consider using a traditional bank for certain things? Are there reasons you'd want to do that?
Absolutely. Well, I think first and foremost, it's good to have a human face to things sometimes, right? If the world is completely taken over by, online, and everyone talks about AI and robots, right? It's not always the best thing. So having somewhere where you can go and have that human interaction is an important aspect of it first and foremost. But second, I think there's two services that come to mind for me that are pretty important when it comes to running your financial world. And the first part of that is, what if you're going to travel somewhere, right? A lot of young people like to travel. I myself just went to Italy last year, and something that you need when you go to Italy before you go is you're going to need a different kind of currency, right? You're going to need euros, right?
That's right.
So you, of course, I'm sure there's another way that you could find a way to get those euros, right? But for me, the easiest way to get those was going right up to my bank teller and saying, hey, I would like to place an order for euros in this amount. And they will do it for a small charge, right? So that's an important part, right? Sometimes when you go over and you're traveling abroad, getting euros in the country is a little bit more expensive than getting it in the bank beforehand. So it's good to have that option before. And then I think the second point that's really important that comes to my mind is a cashier's check, right? So I'm about to get married here very shortly. And something that you need a cashier's check for, if you don't know, and if you're thinking about getting married, this is an important part, is you need a cashier's check to do that final deposit for your wedding venue. So if you have an official enough venue that they want that cashier's check because they want to know that it's not going to bounce, right? Or if you're renting, they're going to ask for a cashier's check for that deposit usually sometimes. So just making sure that you have access to that. And sometimes the online bank can be a little bit more of a hassle than what you're going to want to go through. And maybe you don't want to sit on a call line with a lot of other people for that.
Gotcha. All right. That makes a lot of sense. Nice.
Yeah, I would actually back up one more step too on Joe's point on the currency piece. Just getting physical cash dollars. I know it'd be pretty difficult to get cash out of your computer if you got an online bank.
Well, even some such as like Capital One or some of the Ally Bank stuff, they claim that they have ATMs, ATMs around, but you'll notice that they're not always in the most convenient of places, right? You're going to have to drive maybe 30 minutes in one direction to find a compatible ATM, right? So not always the most convenient to your local bank there.
Great point. So when we talk about now setting up our accounts, we've got our emergency funds. Is there any other maybe money beyond that we want to think about holding in cash, or just some more structure we want to have inside of the accounts?
Absolutely. I think so. Just to refresh, right? The emergency funds we're keeping at an institution that's separate from our day-to-day activities, right? So ideally, out of sight, out of mind, right? So that emergency funds are separate, earning interest at a high rate, hopefully. But in our immediate cash bank area, we want to make sure that we have enough checking or enough dollars in our checking account to cover all of our expenses. But also we want to make sure that, hey, we realize that life isn't day-to-day, month-to-month all the time, right? We have things that we want to do, maybe buy a home, maybe we want to do a renovation, maybe we want to go on a trip, travel, right? So those things can't all hang out in your checking account, right? Because otherwise we risk the fraud that we were talking about, maybe having too much in your checking account that's not really earning anything for you. So what I like to do is I like to have a bucket approach, right? So I have a couple extra savings accounts that are in my bank, and those are specifically designated for those projects, right? So I have a specific house fund, I have a specific travel fund, and depending on whether I hit a certain cash goal in those accounts based on whatever my budget is for the month, I put extra amounts into those savings buckets.
Excellent. That's a great idea. And I've noticed that for myself too. So I use an online savings account for myself as well. And you can either do it, an account for each of those different types of items. I've seen some where you can use the same account number, but there's kind of buckets built in to that one account. And I think it's a great tool to see how you're tracking toward those different pieces, right? One of the things that I encourage my clients to do, in addition to having the emergency fund, is that I call it planned savings component, right? Or knowing that there's a project that they're going to want to accomplish in 1 or 2 or maybe 3 years, right? A new car, down payment on a house, right? Those big one-time expenses. And we want to build up the funding for that in cash, right? We want to use cash because we know it's going to be stable. We're going to earn interest on it. It has the FDIC insurance, right? And in those short-term kind of time frames, we don't want to be using anything that's too aggressive, right? For example, if I know somebody is going to have a major purchase within the next 12 months, the money that they're setting aside for that, I don't want that to be invested in the stock market, because there's a chance that come 12 months from now, the stock market could be down, and now they don't have the money that they thought that they would have and that they need, right? So when we're talking about those short time frames, 1 or 2 years, give or take, saving into cash and building up that cash, I think is really, really important.
Yeah. I would say one of the most common examples of that I saw at the bank was tax savings accounts. Folks saving up for property taxes or school tax bills, or even if they anticipated a tax bill in April. Specifically for property, if you don't have it escrowed into your mortgage payment, it's a way to kind of continue to save and be prepared for that. Essentially, you're escrowing to yourself. You're allowing yourself to earn some interest on those same dollars that you'd be paying to your lender, and they would be doing essentially the same thing, holding it, earning a little interest over that time frame, and then paying your tax bill when it was due.
One thing I would add into all that, I think the best way to make sure that you're hitting those cash goals is to make it automatic. Pay yourself first, right? So if it is a way that you have it set up similar to me, where you have multiple different accounts, maybe not under the same account number, but make it automatic. Wherever you have that paycheck coming in, maybe to your checking, making sure that you have an automatic, I know that I'm going to be saving X amount of dollars every month to this goal.
Mm-hmm.
Yeah, that's a great point, Joe. To build off of that, one of the things that I will do for clients, let's say they're planning on buying a new home in the next couple of years. I think one great way to kind of test the affordability of that for them is to figure out what that mortgage payment would be, or if they're already living in a home, figure out what that difference is, right? How much extra will that new mortgage cost them per month? And use that as a definite kind of forced saving. So, for example, if it's let's say a first-time home buyer, they know that the difference between their rent and their mortgage, based on the value of the home that we're projecting out, let's say it's going to be an extra $2,000 a month. Well, right away, we should plan on driving $2,000 a month today at least into a savings vehicle. And that helps us prove through their cash flow that this is really affordable for them, right? And if we can't do that, then we need to kind of readjust our expectations, or maybe we need to bump that time frame out a little bit until when they can do that. But I like your point, which is pay yourself first, right? And build up that cash, especially knowing what that goal is going to be.
So John, is that on top of? So let's say let's give an example, hypothetical client for that, right?
Yeah, sure.
So let's say a client has a rent of $1,000 a month. Now, if you could find a place for $1,000 a month right now, I will take it.
Right.
But
that's right.
Would you suggest, if the home payment is going to be $2,000 a month, are they driving $2,000 on top of their already rent, or is it $1,000 that's going into that?
Well, I would say at the very least it's going to be that $1,000. It's going to be that differential, right? So the point is to make it feel from a cash flow perspective as if they're already paying that mortgage. Certainly, I think we'd like to see them put even more in, because we want to build up that down payment. But yeah, the goal is get yourself in that position where it feels like you're already in that house, or you're already in that car payment even before you're there.
Great. Yeah, no better feeling than habit, right?
Right.
It's smooth, seamless transition.
That's right.
Yeah.
That's right. So one of the last things I think about when it comes to cash strategies and saving strategies, I get a question sometimes when we're working with clients, say that they have a mortgage or they have a car payment, they have some type of debt that's outstanding. One thing that they will ask is, should I focus on paying off my debt as soon as possible, driving all my extra cash to that, or should I look at building up this cash reserve? And I guess what's the order of operations, if you will? And one of the things I really counsel people to do is to try to do both. But definitely we want to be building up some cash at the same time. If we don't already have our emergency fund in place, we've got to be building that up at the same time we're trying to pay down debt. And the reason is because if we don't do that, we can end up really creating a debt loop for ourselves. Meaning, if we don't have any cash reserves, like Justin was kind of talking about before, we don't have our emergency fund, we have an unexpected expense, and we have to put that on a credit card, right? Well, then if we just try to pay off that credit card 100%, we still don't have anything in the bank, we're just paying off that debt. What happens when the next unexpected expense happens? Gets added back on the debt, right? So it just creates this loop of debt, payoff, and the way out of that cycle is by building up that cash reserve very intentionally. So again, when we talk about order of operations or just some foundations of cash flow, I always think, obviously we want to be smart, we want to have a strategy around paying off debt, but part of that strategy has to be ensuring that we have those emergency funds in place. All right, well, gentlemen, thank you for joining me. As always, thank you all for watching, and we look forward to seeing you in a future episode of the Future Value Podcast. Take care.